Is the 50-year mortgage really a good idea? They're calling it a way to help buyers afford homes again. What they're not telling you is who it really helps, and it's not you. I'm Joe Nelson, top Kansas City Realtor, mortgage originator, and a 21-year Air Force veteran, and I've got a front row seat to what's actually happening in the housing market right now. Let's be honest, we do have an affordability crisis in our country. Home prices have surged, interest rates have doubled, and wages haven't kept up. That's why so many families are moving to the Midwest, because Kansas City is still one of the most affordable, family-friendly markets in America. You can still buy a great home here without selling your soul to the bank. But this new idea, the 50-year mortgage, it's being sold as the solution, and I get it. Smaller payment, easier qualification. It sounds like relief, but it's not relief. It's a trap that quietly stretches your debt, slows your equity, and delays or even eliminates your retirement. So let's talk about why this isn't the fix and where it's actually coming from. Stick around because I'll share what smarter homebuyers are doing instead. Let's start with the math, because numbers don't care about how you feel about affordability. If you buy a $400,000 home with 5% down at 6.5% interest, your principal and interest payment on a 30-year loan is roughly $2,402 a month, and it drops to about $2,142. Remember, this is not your total payment, just principal and interest. For the sake of comparison and varying costs, we're leaving out your escrow portion, which covers taxes and insurance. So yeah, your monthly payment falls about $260 on a 50-year mortgage, but that savings costs you more than $420,000 extra in interest over the life of the loan. You're not saving money, you're paying almost $500,000 more to the bank for the same house. And in those first 5 years, the picture gets even worse. With a 50-year loan, you've built less than $6,000 in equity. On a 30-year, around $24,000. That's 5 years of payments and almost nothing in ownership. So before you stretch that loan to make the payment look easier, ask yourself this. Would you rather find a way to earn or save an extra $250 a month, or hand over $420,000 in extra interest for the privilege of slower progress? Here's the truth. This 50-year mortgage idea isn't something buyers have even been asking for. It's being floated from the top. The conversation started at the federal level, framed as a way to make homes more affordable by stretching payments further. And while some policymakers and economists see it as another potential tool, the reality is it doesn't fix the core issue. Let's be real. Home prices aren't going down. Builders can't suddenly cut their costs, land isn't getting cheaper, and nobody's volunteering for a pay cut on the sale of their house. Expecting prices to fall to make things affordable is like hoping for negative inflation and calling it a win. It's not going to happen. So instead of pretending we can make homes cheap again, we should be focusing on how people can buy responsibly and build wealth long term, not extend debt into their retirement years. And this hits young families and military buyers the hardest, in my opinion. If you're a first-time buyer or a VA borrower, I get the temptation. You want stability, space, and something to call your own, but too many young families stretch themselves to the limit just because the bank said you qualify. Qualifying isn't the same as affording. Military families especially move every few years. You might not stay in one mortgage for 50 years. You won't, but you'll be in a mortgage for 50 years, not the same one. You sell and move, you restart the clock, and the cycle never ends. You spend decades paying for homes instead of owning them. Other countries have already tested this idea, you guys, and it never ends well. Spain rolled out a 50-year loan in the mid-2000s. It helped inflate their bubble even more before it burst in 2008. Japan tried 100-year family mortgages, hoping families would pass down both the home and the debt. It buried generations financially. Even the UK offered 40 and 50-year loans, and almost nobody took them because the math didn't work. Every time this shows up, it looks like relief until it drives up prices, slows equity, and traps people longer. There are a few rare cases where a 50-year loan could make sense. Let's talk about a couple of them. If you're in your early 20s, just getting started, and renting is basically paying 100% interest, then owning something can be better than renting forever. Use it as a bridge, not a lifestyle. Get in, build equity, and start paying extra as soon as your income grows. Or if you have variable income, sales, small business, or seasonal work, the lower baseline payment can give you breathing room in lean months as long as you hammer principal when the money's good. Notice the key here though. Pay extra when you can. It's like a forced savings account that will allow you to own a home free and clear sooner or set up for your next purchase. But for most families, it's not a strategy, it's a stall tactic. Here's the wake-up call. That $420,000 difference in interest between a 30-year and a 50-year, imagine if that went into retirement or investments instead. Even with modest returns, that could turn into over $1 million by retirement age. Instead, that money goes to the bank and you're still writing checks in your late 60s. We've become too comfortable with debt. too comfortable with financing everything: houses, cars, boats, furniture, you name it. And now companies like Affirm and Klarna are making it possible to split payments on nearly everything. I had a borrower once who financed a pair of shoes at Walmart, 4 easy payments. You know what it did? It almost cost him his house. That one tiny buy now, pay later charge threw off his debt to income ratio right before closing. I get it. Life is hard, money's tight, and everything feels more expensive. But we have to stop normalizing debt as the solution. The goal shouldn't be to manage payments. It should be to own things outright. Affordability isn't about the monthly number. It's about long-term freedom. So what are smart home buyers doing instead? Buy modest. Stop trying to swing for the fences in your 20s and 30s. You don't need your dream home right now. You need a solid one that fits your budget and builds equity. Comfort over flash. Second, increase income. Find ways to earn an extra $200 to $500 a month. Start a side hustle, get certified in something higher paying, or take overtime temporarily. It's easier and smarter than paying hundreds of thousands of dollars more in interest. Third, house hack. Rent out a basement, an extra room, or even your garage apartment. Kansas City's rental demand is strong. Use that to your advantage. And finally, live below your means. The fastest way to financial peace isn't a longer loan, it's margin. Margin gives you freedom, options, and security when life throws punches. If you're thinking about buying right now, let's have a real conversation about what's actually smart, not just what looks good on paper. My team and I will walk you through what your mortgage should look like for your income, your goals, and your family's needs. We'll always put your family first and our commission check second, because we believe that when we serve your needs first, you'll come back and we'll be your realtor for life. That's how both of us win in the long run. You don't need to buy your dream home right now. You need to buy the home that sets you up to own your dream later without a mortgage. I'm Joe Nelson with the Nelson Home Group, helping Kansas City families and veterans make smart, long-term housing decisions that protect their freedom, their finances, and their future. See you next time.